I'd like to introduce our next speaker, John Mousseau. John joined Cumberland Advisors in September of 2000. He's currently an executive vice president and the director of fixed income, as well as portfolio manager for the municipal bond investments. In this capacity, Mr. Mousseau and his team manage portfolio construction, trading, and research for both tax-free and taxable bond accounts. He has over 30 years of investment management experience. Ladies and gentlemen, please welcome John Mousseau.
Nice to meet you. Thanks, Robert. Appreciate it. Is the clicker up here? It was. Maybe Jim has it. I'll get them to click and talk. Hi, thanks, and thanks for having me here. Appreciate it. I get to talk a little bit about the backwater of the investment world, the municipal bond market, and a little bit about us. Cumberland Advisors is an RIA. We're based in Sarasota, Florida. We have approximately $2.8 billion under management. About $2.2 billion of that is in bonds, and the majority of that is in municipal bonds. We run them all through separate accounts. And in addition, we run a municipal bond ETF under the symbol CUMB. We're a little different in the fact that we have a total return style, which means when we put together bond portfolios, the kind of portfolios we put together this year aren't going to look the same 2 or 3 years from now, and wouldn't have looked the same 2 or 3 years ago. So we manage money on over an interest rate cycle. And what I wanted to bring you today was a little bit about what we're think about municipal bonds right now. Did we get the clip? Okay. If you go to the first slide. There you go. I think they got it up. They just did it. Oh, it's right. And it's got it. That one. Thank you. If you go to the first slide, if you go back and look at what happened last summer, and you went from the time in June, right after Brexit, to where we were right before the election, you can see that municipal bond yields drifted up, as did other yields. Because if you remember the period after Brexit, when England surprised everybody, we saw the 10-year Treasury bond yield jump from 160 all the way down to 130 in the space of about 7 or 8 business days. Sometimes you don't see that type of movement in 5 or 6 months. We thought it was way overdone, and I know Mr. Johnson was speaking before about interest rates rising. Well, you know what? They've already risen, as we'll see. What happened after Trump? We saw a giant rush up in yields. So if you think about where you were prior to right after Brexit, and you had a long municipal bond around at 275, well, by the time that the election came around, that long muni bond was probably around 3. Well, within a month, it was at 4. And think about what were the reasons why yields jumped so much. And Treasury yields jumped as well. That 10-year Treasury bond went from a 160 all the way up to a 260. A 30-year bond went from about a 255, 260 all the way up to a 325. It was the expectations of Trump, the president-elect. So think about 4% growth was being discounted into the markets. $1 trillion of infrastructure spending. Tax cuts, both corporate and personal. Lots of issuance of municipal debt in an infrastructure program. Fiscal spending on a level that we haven't seen. So all of this was baked into the cake very early on, and we saw yields rise up. What we've seen since then has been really the euphoria of Trump the president-elect has given way to the reality of Trump the president. And what we're seeing, of course, is things that other presidents have seen as well. It takes a fair amount of work to get stuff through Congress. There's a lot of congressional inertia. There's been some stubbing of the toes from an administration that's new to this. And what we've seen is really some reversion to the mean. And that's what we thought would happen at Cumberland. And we used that time period right after the election to start expanding maturities and durations on portfolios. And as we'll see, some of the market has cured up, but a lot of it hasn't, especially in the long end. And when you think about the fact that you can still get a AA 4% tax-free bond in the longer end of the market, which under today's tax rules is equivalent to over a 7% taxable equivalent yield. And as we can see with the consternation that's going on in Washington, this current tax structure may be with us a little longer than we thought. So there has been this reversion to the mean. If you look at this and you look at the Muni yield curves from the post-Brexit to the post-Trump, really from June until now, it's been a pretty large jump in yields. So the idea, as we'll see later on, whether we're going to even higher yields, we think we're going to stay around this area for a while. And as we'll see, the Fed raising rates, they're going to be taking it slow. You're not going to see the kind of Fed rate hikes that you saw in previous cycles where they raise rates at every meeting, because you had a Fed that kept short-term interest rates low for essentially 7.5 years at a range of 0 to a quarter point. They are not going to be raising rates fast because they do not want to shock the economy. Here's what's happened since then. There's a mislabel here and it says Treasury, it should be Muni. But what we've seen since the beginning of the year is municipal yields on the short end have come down. The longer end has stayed sticky. We eventually think that comes down. Why did short-term municipal yields come down? A lot of it was the expectation that, hey, the Fed is going to start to raise short-term interest rates, and at the beginning of the year, short-term muni yields were too high. And in fact, if you drew a high-grade tax-free yield curve of the highest quality, at every point from 1 year to 30 years, it was yielding you more than treasuries. That makes no sense. And once they realized that, hey, treasury rates are going up and muni yields are too high right now, they actually have bid down yields in the front end. We think the longer end of the muni market is absolutely a giveaway right now, and have done that with our portfolios. If you look at a chart like this, which shows municipal bond issuance, this tells the story right here why we think that munis are so attractive, particularly in the intermediate or longer end. Last year, you set a record for issuance with over $460 billion of bonds issued last year, or 450. And a lot of that was all to refinance older, higher coupon bonds. Well, that's behind us, not in front of us, because interest rates have risen. So as you go into this year, there's not going to be anywhere near the amount of refinancings, and the amount of debt being issued by municipalities is actually much smaller. We're running at about 30% behind last year, maybe even more. And of course, some issuers are kind of holding off because they want to see what the tax bill might look like. We may not even get to that till next year at the rate that we're going. So we think the fact that issuance is declining right now also plays very well into the municipal market for this year. This is a little bit of what the last 9 years have been like in the muni market, and it has been truly feast or famine. And this shows long-term muni bond yields. And if you look at basically in 08, we had a sell-off after the Lehman Brothers collapse. But that was a sell-off of all sorts of other bonds as well. Anything other than Treasury saw yields rose. And the market didn't want to own anything. It didn't want to own anything but treasuries, didn't want to own corporates, munis, junk bonds, didn't want to own real estate, obviously stocks as well. But the last three crises have all been pretty much not related to economics, and they've been related to some fear in the market. So we had the sell-off in 2010, early 11, when Meredith Whitney, a noted bank analyst, said there was going to be hundreds of billions of dollars of municipal defaults in 2011. It didn't happen. Didn't stop the bond market from selling off. 2013, we had the taper tantrum when Ben Bernanke said he thought we might taper sooner rather than later, and they sent yields soaring for no good reason, because inflation was coming down, it wasn't going up, and growth was declining, it wasn't going up. And then we have the latest sell-off right after the election. Again, there was nothing economic based on the sell-off. What the sell-off was generated by were bond fund investors fleeing the market and selling their bond funds, redeeming their bond funds. And a bond fund portfolio manager has no other choice than to sell bonds when they're met with redemptions. And most bond funds own bonds in the intermediate and longer end of the market, so that, to meet their dividends, so that's what they sell. So this last sell-off was no different. And if you notice, the yields, as they increase, if you took out a ruler and put it on there, you'd see yields are going up at an increasing rate. That is very rare in a market, and it has always marked a great opportunity to add some duration and add longer maturities to a portfolio, and we feel like this time was no different. Oh, excuse me. This is a chart showing bond fund flows, and here's the culprit. We can see the massive outflows back in 10 and 11 for Meredith Whitney. We see the massive outflows during the taper tantrum, and we saw outflows again during the Trump sell-off. To give you some perspective on how fast and furious the sell-off was, if you think about a bond that was issued right around the time of Brexit, a little after Brexit, and you'd have a long 30-year municipal bond issued at 3%. Less than 6 months later, in December, that bond was selling at around a $4.25, or roughly around an $83, $84 price. In other words, a 16-point drop in bond prices in a very short period of time. That's a little scary, but it also represented a great opportunity in our eyes, and we tried to take advantage of that. But it shows you that the bond funds flows can really dictate some of the market. And in fact, what we've seen this year so far is that the bond fund investors seem to have, realized that things went too far, and you've actually seen positive fund flows in the last few months. In fact, almost every week but 2 in the last 3-4 months. Treasury's no different. You can see the jumping yields right from the time after Brexit, the first line. It made some ground up before the election, and then the giant jump up to the yellow yield curve line after the election. And since then, what have we seen? We've seen a flattening of the yield curve. I think Craig Johnson was talking a little bit about that. And short-term yields have risen in Treasuries, and why? They've risen because there's the expectation that the Fed is going to continue on their interest rate hike cycle. What we've also seen, though, is longer-term yields have come down somewhat. And we would expect that longer-term yields will probably stay where they are and take a while to get up. And someone made the point about getting back to a 3% 10-year bond and a 4% 30-year bond. By the way, that's where you were at the end of 2013, so it wasn't that far out of recent history we've been there, and the economy's done fine. And I think it's important to remember for bond investors that gradual rises in interest rates are good for portfolios over time because you get a higher reinvestment rate. The next 2 charts talked a little bit about what's happened. The yield curve steepened up immediately after the elections. This is 2s versus 10s Treasuries. The next one is 2s versus 30s. But since then, they've come down. And again, it is the same phenomenon at work. It is the realization that the Trump, the president-elect, is going to be having was much more euphoria than Trump, the president, and some reality has set in yet. So the steep yield curve, which usually signifies an economy that's going to continue to grow, has softened a little bit. The last 2 Fed hike cycles, this is 2004 to 06. The reason we have this chart here is to show you that even though the Fed hiked rates ad nauseum for 2 years, and you can see the green step stools going up, longer-term bond yields, which had risen before the Fed hiked, didn't go up. So even though the Federal Reserve raised rates 400 basis points, 425 basis points, longer-term bond yields in Treasuries hardly went up at all, 75 or 85 basis points, 85 on the 10-year and 75 on the 30-year. In other words, the yield curve flattened, and for people who say you have to go and hide out and only own short-term debt when the Fed is raising rates, that's the people that got hurt. You needed to own some longer-term bonds. So managing portfolios with kind of a barbell effect, really proves out in the long run. The same thing was true in the previous hike cycle back in 1999 and 2000, where long-term rates didn't go up anywhere near as much as short-term rates. Quickly here, in the U.S., you can see 2-year and 10-year bond yields in the U.S. compared to the rest of the world. If you were in charge of running a sovereign wealth fund, only investing in developed countries' government debt around the world, you would look at a chart like this and say, the U.S. is a heck of a good buy when you compare it to places like Italy, which have lower yields than the U.S., or Japan and Switzerland, which are almost zero. So I would submit that yields here, while historically low, are still relatively very high. And I'm going to close with this last chart. And the reason I bring this up is we get asked a lot, are we on a different secular path of interest rates? In other words, that path what you saw from 1981 till now of every cycle of interest rates lower than the last, each peak lower than the last peak, and each trough in interest rates lower than the last trough, does that start to reverse? And the answer is we won't know until we go through a full interest rate cycle. And you can make just as good a judgment that you may stay here and have rates go higher, but you won't know until you go through there. So we think to be able to say that we are now heading upward to a higher interest rate path is probably a little premature to say that. I thank you for your time and appreciate it.